It's over. The housing market just collapsed. We have recently seen a complete collapse of the housing market, and its eventual recovery remains uncertain. The housing market is a vital part of the economy, so this is terrible news for the whole economic system. There is no prediction when the housing market will recover from its recent crash. Therefore, it is preferable to wait, or even better, to have a deeper understanding of the system before making a substantial investment. There may be cause for celebration in 2023 if you, like many Americans, saw a significant increase in your rent this year. In a recent real estate newsletter, Tom Lawler, a former Fannie Mae analyst, predicted that national rents would not only slow significantly next year, but also see an unusual actual fall in real dollar amounts. These drops are projected to become more widespread and rapid next year in 2023. There are several areas of the United States where rents have already begun to fall. In the third quarter of 2022, the rental prices throughout the country fell by 0.4%. Contrasting with the previous year's trends of rising prices due to strong demand. Lawler's projection is based on the reality that U.S. builders are continuing to construct development projects, such as new homes, despite the fact that there are fewer tenants who want and can afford new rental apartments. It's a rare tale of surplus supply in a housing market that has been plagued for many years. According to Anthemos Georgiadis, CEO of Zumper, an online rental database, financial and economic concerns among Americans are also causing the decrease. As individuals shifted to working from home and rethought their living arrangements, we witnessed record levels of mobility throughout the epidemic, he added. Now, with a chaotic, uncertain economy prompting fear of recession, migrations are slowing, occupancy rates are declining, and rent prices are following suit. In the rental market, these trends may already be seen taking shape. Despite a 50-year high in multifamily housing development, Rent Cafe reports that demand for apartments is on the decline. RealPage data reveals that during the third quarter of the year, which is generally a busy time for leasing, rental demand became moderately negative as leasing traffic dropped significantly. Since the corporation began keeping track, demand for the third quarter has never been negative until October's drop. As the Federal Reserve continues to raise interest rates in an attempt to calm prices, and the decrease in rent costs may be a lifeline not only for Americans' bank accounts, but for the whole U.S. economy. A substantial slump, including widespread unemployment and a drop in property prices, might be avoided in the United States if falling rents convinced the Federal Reserve that inflation was under control. Following a record 17.6% rise in 2021 and subsequent increases earlier this year, American renters will be relieved to see rents drop to more manageable levels. Many major cities are already seeing reductions, which may be an indicator of what will happen throughout the United States next year. More than half of the 100 cities in the United States included in Zumper's monthly national rent report had rent decreases from the previous month to October. The median rental price for a one-bedroom home in the United States is currently at $1,491, down 0.8% from September, while the median rental price for a two-bedroom home is down 0.7% to $1,832. San Jose, Tulsa, and Seattle, all of which have seen rent increases in recent years, witnessed a downfall in monthly increases from the previous month. The median rent for a one-bedroom in New York City fell by 2% in the same time period, and the same was true for a two-bedroom in the city. Rental declines might go a long way toward persuading the Federal Reserve that inflation is under control, since housing costs make for about a third of the Consumer Price Index in the Bureau of Labor Statistics' monthly inflation report. In spite of widespread forecasts of economic contraction in 2023, the depth of the downturn may be sensitive to the rate at which prices fall. Both Lawler's findings and the most up-to-date information on the rental market point to positive developments in the future. According to economists, interest rates and household incomes are two of the fundamental economic elements that affect housing prices. Economists for some reason, don't factor in people's expectations for future home values as a major factor influencing present house prices. But they should. Numerous studies have been conducted by economists on this broad topic. Unfortunately, it goes by various names, adding to the chaos. Names like irrational exuberance, learning from prices, momentum trading, biased expectations, adaptive expectations, diagnostic expectations, and price expectations all refer to the same underlying concept. Despite the many labels, the concept is simple. If you believe that housing prices will rise in the future, you will be less likely to sell your home today and more likely to acquire one at a premium to the current market price. Because of this belief, home prices rise even more quickly, which in turn encourages more individuals to believe that home price increases are inevitable. Generally speaking, a price increase leads to an even bigger price increase. Lower prices in the future lead to further lower prices in the present, because those who foresee future price drops are more likely to sell their homes and less likely to purchase at today's market pricing. People who aren't involved in the real estate market are also impacted. Lenders may become more inclined to lend as prices rise because they anticipate larger profits from doing so, which in turn encourages more people to chase the housing market by spending more of their own money on it. It goes against the principles of conventional economics. There is an expectation that consumers would consume less when prices are raised. In the long run, rising prices will lead to lower demand, but in the short and medium term, they may actually raise demand if they lead consumers to anticipate more price increases. When prices decline, however, the opposite is true. Perhaps this is why economists shy away from labeling pricing expectations fundamentally. It's simply too complicated to explain why secondary effects of price adjustments or their influence on future price expectations may sometimes temporarily outweigh their primary effect when it comes to housing. Whether home prices are going up, down, or staying about the same, the anticipation that the pattern will continue into the future is also a major factor in the present demand for housing. In the housing market, mortgage rates play a crucial role in determining overall demand. Interest rate fluctuations on a mortgage have a significant effect on monthly payments when financing a large purchase over a long period of time with a small down payment. Mortgage rates dropped for 2 years beginning in late 2018, lowering monthly payments and increasing home values. The demand for homes was already high before the pandemic altered other fundamentals. After January 2021, interest rates would no longer decrease. In early 2021, stimulus payments were discontinued. Even the concept of freelancing had become old by that point. Nonetheless, real estate values were skyrocketing until May 2022. Real estate investors who had previously significantly benefited from rising home values often increased their wagers by taking on even greater levels of debt in order to fund further property purchases. Potential buyers who planned to live in their homes were anxious to act before prices rose any higher for fear of being priced out of the market forever. A large part of the reason why home prices keep going up in 2021 and 2022, despite many fundamentals turning negative, was because people expected them to. People generally estimated from previous price increases the idea that everyone else is offering tens of thousands over list price, you have to too, likely played a role in our decision to do the same. Then in 2022, interest rates on mortgages suddenly shot up. As soon as the punch bowl was removed, the music stopped. As expected, the market for housing was stabilized. The likelihood of further price hikes was reduced. As long as prices remain stable, the portion of demand based on projections of the future will continue to shrink. Because individuals are gradually decreasing their expectations for future home price rises, demand will continue to shrink for several months, notwithstanding mortgage rates. As more people anticipate home price hikes in the future, housing demand decreases. With demand already dwindling due to lowered pricing expectations, another round of Fed rate hikes would be devastating. Many cities' median home prices, including Phoenix and Boise, have already begun to decline. This would completely alter the dynamic if prices dropped and stayed low for an extended period of time, leading many to anticipate more declines. A new, although negative, the feedback loop would be established, with the result that prices would continue to fall. It's highly likely that this year, instead of saying, "Let's buy ASAP," homebuyers will say, "Let's wait and see." Thanks for watching this video. I really hope you enjoyed it. Additionally, if you're new to this channel, I strongly encourage you to subscribe and click the like button. You can also keep up with all of my most recent videos. See you in the next one.